Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The markets in general last week had quite the rough ride after the Brexit vote, with the UK electing to pull out of the European Union. It hasn't been taken well in general, and the markets responded in kind, but it remains to be seen how the rest of the world and the UK itself is going to digest exactly how they're going to march forward. As we can see here on the CRB index, we continue to rest at key resistance as the market has pulled back up to the 2474 to the 2604 area. This continues to be a very important operating zone, and if the market falls from here, we can see the markets decline. And if the markets are able to break above the 2604, 2605 area, we could very well see continued strength up to about 2809 to 2810 before finding some very serious resistance. After everything washed out last week, we can see here on the July corn contract, the market moved down a full half cycle to that key 388.5 number that we spoke about last week. The market had a very nice decline coming off of its highs. After hitting the 428 to 429 area, the market had a very nice decline straight down to the 360-degree mark. And you'll also notice how the market here is hugging along this natural support level. Now, breaking below here, we could very well see the market come down and try to test this 90-degree mark of 369. And what we're looking at is a potential continuation pattern here for continued weakness for the corn contract. Now, mind you, the market is a bit oversold, so we could see a small bounce up through here where we would see some resistance at about 408.5. But up at 408.5, we could very well see another big decline, and that would indicate a move that points towards a full cycle down, as we had very good resistance up against the 180-degree mark. So then a move down to about 350 would not be unreasonable. But the caveat here is that this contract has first notice date in a couple days, and so really we want to move on to the next contract for further details. Likewise, we can see here the market was up against the point of control at 432 3/4. Upon breaking below that level, the market really made a beeline down to the next key level, which we talked about when the market hits their particular vacuums. After making that beeline down to 390, we now find we have a little bit of support as the market is hanging out near this area here. But breaking below 390 in a strong fashion could very well send this down to the next level, which would be about 363.5. Moving on to the December contract, let's look at some of the key areas here in terms of what we're looking at with price action. Market came up to the 180-degree mark, 467. Upon hitting 467, we saw massive resistance. The market moved down one full half cycle to 406. After breaking through 406, we barely touched 90 degrees below that number at 387, or rather at 386. We bounced up from there, found resistance again at the 360-degree mark, and have since moved back down. It's highly probable that the market then should make a move down to 366.5 at a minimum. So we want to continue to monitor its price action and see what's going on here. But really a break below 386 or below 385 3/4 should point to a move that should touch 366.5 at a minimum. In this chart, we'll see the vertical timeline that we spoke about before. Interestingly enough, the market dropped a couple of days before that timeline, moved up into it, and is now since declined back down again. So what that tells us is that we're looking at the potential of a 2 or 3 day pullback with the market moving back down, back below key levels. We also see that the market had hit key support right along the 390 to 392 number. And below this 392 number, we expect continued weakness. Now, point of control, or at least one level below the point of control, is at 387 and a quarter. And so below 387 and a quarter, we're then looking at a move potentially down to 364, consistent with the previous chart that we looked at. Last week, we discussed our belief that the market was going to probably come down to about 1110 and bounce from there. And sure enough, that's exactly what it's done. We've seen two very nice moves up since then. And in early trading, the market's seeing a little bit of pressure. The market did come in and become oversold from that bounce at key support. So very timely as everything has really come together. This retracement here is about 50% of this actual range that we see. And after making this move, the market has then since come up. For those who actually looked to actually fade this level or go long along these areas, the market continues to look fairly decent here. It's only expected that we'd see maybe a small pullback, and we're waiting to see if continued strength comes back. We'd have a minimum price objective for this market to come up through here, but since this is the July contract, we'd want to look at the next upcoming November contract instead to perhaps try to play this move. Two levels above the point of control sits at 1150. Currently prices at about 1144 and change. And yesterday's close was just above 1150. So as long as the market's able to stay above the 1150 mark, it has a good chance of actually reaching its potential target overhead and maybe retesting that previous high of 1110, or rather of 1210. So we'll continue to look at what goes on here for this contract. Last week, we outlined where we believed key support was going to live for this contract well in advance of it getting there. We also thought that the market was going to move down to being oversold, and you'll be able to notice here that both of what we had discussed has occurred. We thought that 1076 was going to be key support. That's exactly where the market came down to and really had a very strong reversal from that level. The market came in and became oversold as anticipated. And after this bounce, we're now seeing a little bit of correction in early trading, as mentioned before. But again, now we see some of our key target levels ahead of us. If the market's able to continue with some strength, what we'd be looking at is a minimum price objective at about 1186 and a quarter, and with the possibility of moving up to about 1210, maybe even as high as 1234. So we'll continue to monitor this price action here with the soybean contract, but we're hitting some very key important thresholds that are looking at a potential move in the short term that may point to our last move up before we see a very big decline going into the summer months. Now, it's also possible that this advance that we see would be slightly lower or make a slightly lower high than the previous high, which would be an indication of weakness occurring even earlier. So we'll want to monitor how it moves over the next couple days, especially as we're approaching the USDA supply and demand quarterly report on Thursday. The price action in the July wheat contract has been a thing of beauty. We shared with you last week that this was a continuation pattern in that we're looking for the market to make a decline consistent with the move down into it that we saw coming in right here. In doing so, we'd be looking for another move on the other side, and we shared that our minimum price objective for this price action was at about 444. Well, we tagged that, and everything has really come in very nicely, exactly as anticipated, and wheat continues to look like it wants to be weaker as well, and could very well go down to the 430 mark. So as far as this contract is concerned, we're currently sitting just below the 447 mark. And so the next key operative area that we'd be looking for is a price move down to about 433.5. Again, wheat has been very weak and looks to continue to be so over the next coming weeks. And so we'll simply move forward onto the deferred contract since this guy is coming off. There's not much ahead that looks to point to continued strength in any fashion for wheat. And so we'll simply continue to play it to the short side. Last week, we shared that the August crude oil contract was at a critical point. The critical point that we saw, or the pivotal area, was the $50 mark. At this $50 mark, the market had made its move up, and we suggested that one of two things could occur. We'd see a very nice strong move to the upside or a very nice move to the downside. The downside is the direction in which it chose to move. In doing so, we have our wave 5 high confirmed. After that wave 5 high is confirmed, we're sitting at an ABC movement that could very well come down and touch the 44.5 area for this contract. We've seen a small bounce from the 46.62 area, but the market's looking at a little bit of weakness right now. And so really it's moving very nicely. For him right now, he's sitting at volatility-based support right inside of this area between 46.60 and 44.70. If this market's able to come back down and break the 46.60 number, we believe touching 44.70 should not be an issue, and it could very well move lower from there. We're moving into the key traveling time in the summer months, and so we'll see potentially some volatile movement here for the crude oil contract, but it's nice to see all of the levels coming into fruition as anticipated. Again, we're now moving into key traveling time and holiday time over the next couple days with the Independence holiday coming up. And with that, we will be back again in 2 weeks. Thank you so much for joining us.